Earlier this week, we saw Kraft spin off its domestic grocery division, which will keep the Kraft name from its global snack business, which is now known as Mondelez. Stephanie, I know you traded it this year, and you bought some right before the split. So what's the trade now?
Yeah, I think you can own both positions. You're going to get both positions, most likely. Mondelez has the highest growth. They are the company that 75% of their revenues are tied to the fastest growing products in packaged food. So gum and candy and chocolate and biscuits, where they have a number 1 or number 2 market share in all of these. They also have 44% of their exposure is tied to emerging markets, which are faster growing regions. 33% are BRICS. So they've got a lot of good exposure, got a lot of good products, decent geographies, and so I think they're going to continue to expand their market share, and I believe that they'll be able to grow 5 to 7% organically in revenues and about double digits, low double digits in earnings. The stock trades about 17 times forward estimates, so that's not cheap, but about 1.5 times PEG, that is cheap relative to its peers and relative to what its peers' growth rates are. So it's going to grow much faster. The North America piece is kind of like what I say is kind of boring, right? It's your North America packaged food company. They are the number 4th largest in the U.S. They have size, they have scale, they have good brands. They don't have a lot of growth. They've got 2 to 3% organic growth. They've got about mid-single digit earnings growth. So to me, 16 times forward estimates for that is less interesting. But I think if you get it, you hold on to it because you have the 4.5% dividend yield, which will grow 7 to 8% over the next several years.
Looking at the Mondelez business and Kraft, I guess, as well, how are commodity costs going to impact these going forward? How are each business addressing them?
Well, it's interesting that you mentioned that. So back in September, before the company split, the company lowered guidance on their various pieces. A lot of that was tied to currency, but also that was also tied to raw material cost pressures. So, in my view, you've actually seen commodity costs come down in the last couple of weeks, particularly oil, but in other commodities as well, a lot of the ags and that kind of thing. So that actually, maybe their guidance is on the conservative side, but it's definitely something to keep in mind. Currency is also something to keep in mind. I think with the strong euro, that might actually give upside to the Mondelez piece. And then on the flip side, North America, if you really believe currency is going to be an issue, they're not going to have it as an issue because they're 100% USA. So I think there are a lot of gives, puts and takes, and I think that at the end of the day, you focus on fundamentals, and I think this company is doing an amazing job at creating shareholder value by splitting up these two businesses, which I think will do better as separate entities versus one entire group.
Now, if you had new money and you wanted to focus on the domestic piece, I know that the Kraft domestic grocery business has the 4.5 dividend yield, but it has a high payout ratio and a high PE as well. Would you put new money to work in Kraft, or would you look at something else in the space, like maybe a Kellogg, I don't know, General Mills?
No, I mean, I think that you hold. I think that the North America, the Kraft business, is a hold. Okay. Because of the valuation. I would rather see it pull back. But I understand why, right out of the gate, it's been strong, because people are starved for yield. 4.5%, you know it's very well covered and pretty safe, and it's going to grow 7 to 8%. So I do not think you need to chase it. I think you hold it and you wait for any pullback to buy it. But for me, the Mondelez piece has come out of the gate kind of soft, and I actually like that. So that's why we've been adding to that position.